Hey everybody, Bob and Phil at Trade Genius. Glad you're with us. So, is a rally inbound? We hit some important levels to the downside today, but did we hit the most important one? Stay tuned, we'll explain.
Trade Genius.
Hey guys, I want to tell you something that we do that really will change the way in which you look at trading and also absolutely help you increase your profitability and how much money you make. It's the Trade Genius newsletter. We put the newsletter out Sunday night through Thursday night, and this really looks at the plumbing of the markets and helps prepare you for the next trading day and help you make money. And we give you a lot of information. We give you market statistics, we give you market levels, we give you the seasonality, what's happening with different sectors of the market, and we will help you identify whether the market's in a bear mode or a bull mode, or whether it's euphoric, whether it's despondent, and it just puts you in a position to be on the right side of the trade. So take advantage of our offer that we have below, and you'll love it. I mean, one trade that you make with this thing can pay for definitely a month, maybe even a year's worth of service. It's that powerful. Use promo code podcast for 15% off the retail price of newsletter. Thanks for listening.
Okay, Phil, we can claim to be right because we were talking about this when we weren't on the air the other day, but we said, watch out for SPY 411, 412. We told our subscribers it was going to hit there. This is what price was at 418. People scoffed at us, and what we got down today was 411, 412 area. We bounced, we came back a little bit. So now that's a really important level. And, if we get a dead cat bounce, we may have a few days, but that may not be it. And I'm going to throw it over to you. Why don't you show people why it's going to be hard to get a short-term bounce, but at certain levels we can get a massive bounce.
Let's take a look at the gamma situation. And for those of you that don't understand what gamma is, it's basically just, kind of what forces the market into a certain direction or a certain mode. In this case, we're in a bear mode. But if you look here on this chart, you're going to see all these lines, and what they represent are basically the buildup of gamma, or where the big positioning is at various strike levels on the S&P 500, or in this case, the SPX. So what we have highlighted there in white is essentially the strike 4100. It might be a little hard to see, but there's a lot of blue on that level, and blue is puts, orange is calls. And you guys will see there's the blue stuff is really dominating down here versus the orange bars. And the reason for that is there's just more put positioning down here. So what ends up happening is, a lot of times you'll hear, oh, we have tailwinds into OPEX. Well, this is the exact opposite of that, where you have headwinds going into OPEX. And that's why this market can't seem to catch a bid. Now, this will change, but it really comes down to positioning of the market participants. So until we start seeing the call gamma build up around these levels, we have to just assume that we're going to be heading lower. Now, over to the left a little bit, we got a really big bar that's got huge amount of blue and a pretty decent amount of orange, and that is the 4,000 strike on SPX. So while we think we have some support here, guys, that means another 100 points lower on the S&P 500. That's a very large level. Now, I'll credit Spot Gamma for this chart. This is theirs. They come up with these levels and they show us the positioning, and this stuff can change too. But as of right now, going into the end of this week, going into the next week, you have to be very leery that this area is eventually may break down. Now, why we think that might not happen just yet is because we're going to dive into the charts here a little bit on what the current situation is on the S&P 500. I've actually got the SPY up, which is the ETF for the S&P 500. But if you guys kind of notice what's going on here, we just touched down into this massive volume node here. So what this does is tells you how much volume occurred at every price point. This is called a volume profile for those that you aren't familiar with it, and basically displays as a histogram on the side of the chart. But it's really important to reference, and I don't really use it on smaller time frames, but when you're looking at a daily or weekly chart, these massive volume nodes matter a lot. For example, if you look at when we came down from the highs, right? What do we come down and bounce into? This big volume node here, right? And then we bounce back up into that gap area and roll back over. And then as we come back down, when you get this move of a gap down, like when this closed here below that volume node and took out that low, you pretty much know the bears are in charge at that point, right? And then we end up pushing down. You get into another volume node here that gives you some support. And then that eventually breaks down to another low, into another little volume node here. Then what do? We get an oversold rally, right? because we're in a bear market right now. Think of it that way. And you get these sharp rallies. These are going to continue to happen. But what do? You rally right back into that high volume node that was support, now resistance. Extremely textbook stuff. On top of that, you had a big, head and shoulders pattern up here, right? So, there's no coincidence, right? You got the head and shoulder pattern, right? And then you get to bounce back up into the neck of it right here, right? And rejection. Oh, and by the way, there's a big volume node. So if you know where to look, some of this stuff, it's not a mystery. Like, you're expecting these levels to have a big reaction. And so that being said, we're expecting this level to have a decent reaction as well. Now, is this going to end the down move? I don't know, because that, like we said, we're in a negative gamma environment. We showed you guys the put positioning. It's going to be the path of least resistance ultimately is going to be lower lows for the time being. And then you have to zoom out and say, okay, well, 4,000, what does that do? That takes you down to the bottom. If you notice, there's some shading here, right? It's darker blue. That's what we call the value area. And a lot of times what you're going to do, if you fail one side of the value, all right, this is market profile type rules. If you look at this side here, this is the entire range from our highs that we started in 2022. So it encompasses the kind of like that first bear market action we had, and then we bounced out of that. Now we potentially rolling into a second. The real bear market is what we think. So if we encompass this entire range, you'll notice we failed the value area up here, right? And now most likely what we're going to do is we're going to test the bottom of the value area, which takes us down to about 392. Now, what's interesting about that is I'll flip over to this other chart that shows you the weekly levels and things like that on the ES futures. It's, essentially the same thing for the SPX chart or the SPY chart, but you'll notice that we're cracking below the weekly 50. Okay, cracking below the weekly 50 is a major problem, because that's where typically that's your first warning shot that a bear market is starting, especially when you get this move where you go down, you come back up and you fail right there. And I mentioned that the other day in the room. I said, hey, overnight, this thing snuck up there and failed. I go, that's really bearish. And we ended up puking down. And the way these markets have been going now, you're making either a low or a high going into Friday. So we think we may have, and Amazon earnings came out, they beat, but just like all the other earnings that beat this week, market just shrugged it off. It's just very lethargic. Earnings don't matter. And it's because of the gamma environment, I think, that we're in. So what does that mean? Well, if we go down towards that 4,000 SPX area, we run into this weekly 200 SMA. Now, I'll go to a higher time frame chart. That is a colossal level. And the reason why that's a colossal level is because when you go into a bear market, it's always under the weekly 200 SMA. If you're cracking below the weekly 200 and you start developing a trend under that, you are in a bear market, and you're, I think, with very high probability correlation wise in a recession. Okay. Now we came down into that. If you notice, that was our last year's lows. And what did we do? Massive bounce off of that. So we came down into it, big bounce, dead cat bounce down, actually poked through. This was a massive buy tail down here, big weekly, daily hammer. And then that was it. Boom. And then we ended up making a series of higher highs. Ultimately, this crescendo with the debt ceiling raise, with the T-bill, stuff in the market with T-bills that the banks turned around, used for leverage, and pumped this market to the highs until we got back into this area of resistance up here, right? And then we sold back off. So what this telling you is there's no sustained capital flows to keep a bull market going. We're pulling all the way back down now. And this next test here, guys, if we do get that test, which I think we're going to, is going to be very telling, because if we lose this level, and that means, S&P 500 is going to be, it's going to be, around that 4,000. If we start, basically the bottom line is this: if you lose 4,000 on SPX, brace for a recession, brace for a bigger bear market, because these are all the things that happen in every bear market that we've ever had. And so that is the big picture, Bob. I'm going to kick it back to you and get your thoughts.
Yeah, the first thing is, when we talk value area, that is the area where 80% of all the volume transacted. And a lot of times too, when you miss the midpoint, what they call the point of control, a lot of times the market likes to test one end of the value area to the other. And it just happens to coincide with some really important levels on options, derivatives, and also the moving averages. And so people always ask us, well, if people keep shorting, why would the market go up? And a lot of times it's because the reason why the market's driving down with what they call negative gammas, there's just more puts than calls right now on average, and prices under that balance. And so you get to a situation where those guys writing those positions are saying, okay, I made enough profit, or I closed the position that I was protecting. And then as they close their positions, you get a change in the derivative structure. That's why we have to look at this almost daily to see how these things change, because you can go from a very negative flow fill to a very positive flow just on the nature of contracts expiring or expirations occurring, and there's repositioning out there. So from my point of view is that 200 weekly moving average would be an ideal place for the powers that be to come in and provide a multi-month, bear relief rally again before we roll over, and actually we'll take out that 200 weekly moving average, probably somewhere, January, February timeframe. So that's our view on it. And like I said, our position changes, our views change as the market makers and the institutions position themselves every day. So right now, we hit an important short-term level. We're going into a weekend. We may get a day or two bounce. We go into Wednesday, Phil. We got the Fed meeting. We have 12 days of no bond issuance. Right. So there could be an opportunity for people playing games here unless they decide to hide with the Fed. And then the flows will start changing going into the end of the year, starting sometime in November. So it's going to be a really interesting couple months. But I think a rally's coming. It's just going to come from a level probably that is going to scare the children first.
Yeah, I would agree. And guys, if you haven't really been through a bear market, some of you I know have been around a while, but if you really haven't experienced a bear market, because it's been a while since we've had one, we have a bear market course over at Trade Genius. It lays it out very simple terms, and it gives you the technical tools that you need to basically analyze what's going on. You get chart templates you can use, and you'll be able to just follow along and see how this market does end up developing into a bear market or not. And if it does, where does it end? And we have a unique way of looking at that to tell you when to basically get back into this market and start investing again. Because some of the biggest ways that you can outperform the overall market is stepping to the side when we do have a bear market and then getting back in toward the bottom. You will never underperform the market if you can pull one of those off in your lifetime. Sometimes you get a couple opportunities, and you'll always be ahead of the market over the lifetime of your portfolio, your long-term portfolio. So check that out. We also have our newsletter that goes over these levels day in and day out, week in and week out, and you can also get in the room with us. So check that stuff out over at tradegenius.co. If you have any questions, leave them in the comments below. We'd also like to hear your thoughts on where you think the market is headed from here. Thanks, Bob. We'll see you guys on the next video. Take care.
Trade